Okay, let's look at British pound, Japanese yen, and some other instruments quickly. Um, I'll just do some top-down analysis. If you look at this, we are clearly in a bullish market, so we are looking for buys. And if I have to pick some trading strategies from Raja Banks, you look very well that this is the resistance that was formed here, this is the support, and this is the breakout candle above the resistance that was for yesterday. So today, if we get a bullish breach or a break of this top week, we're anticipating price to keep pumping. But if we are going to enter on the break of this, we will not be getting precision entry, meaning we will not be entering at the best price. And if we enter here, where are we going to put our stop loss? Below here, which is the previous day candle, will be too big in relative to our TP. Okay, and we can't categorically say how the price is going to come if we're just going to keep price on the low here if we have a bullish breach here. Let's assume that we already broke the high before London open during the Asian session. What do we do? Let's assume that before London session or before pre-London we had a bullish breach and candle was bearish. Do we now take on the break of the new today's candle when it turns bullish again with our stop loss on the low that was created, or do we create a pending order on the break of this high in anticipation for price to keep rallying? This is what I mean. Two things here. Do we enter a buy? Let's say we came today and as I yesterday when the candle closed, this candle has not opened yet. We put our pending order here. Where would our stop loss be? Since we don't have any candle yet, that is for today. Do we put a pending order here with stop loss here? This will be too high or too big a stop loss. Now, if we come and candle has already formed a high and now it's forming a low, do we now enter with respect to the current day, which is today's high or the previous day's high? This will now result in us doing what? Dropping to lower time frame. Now, going to the lower time frame, we have the same approach. This is previous day. We're in buyer's territory as well, just like yesterday. Now, if you look at this, you'll see a consolidation on the 4 hours time frame showing weak consolidation. In other words, sellers are very disinterested. We have high influx of buyers. Now, where would our stop loss be? And just like I said, before this is 1 o'clock candle, before this candle was created, we had a break of the previous day's high. So if we were already active, where would our stop loss be? Below the previous day's low, which would be too big. Then again, if we're going to enter on the break of this high, since it has already made a low, our stop loss will now have to be here, which is tighter. It's better than entering here and putting our stop loss here. So if we enter here, put our stop loss here, we're using a wide range of sampling method. Okay, whereby it has broken the high, it created a low. It's just like price opened here, went high, came low. So these are our two extremes now, the high and the low. If price continues down, okay. But if it comes to break this high, we're anticipating that if it comes to break this high, it should never come back to break this low unless it has given at least a reasonable um, deviation from this mean point, which will now act like our what? Our median value or middle value. In other words, the distance from our entry to our stop loss will be equal to the distance from the entry to our presumed TP. This is what I mean. I'm trying to infuse some mathematics in this. Let's say the range from here to here is 20 pips. So mathematically, for us to have a stoichiometric balance or for a stoichiometric ratio to be said this is a balance equation, the entry to our presumed take profit should be what? 20 pips as well, which makes this a what? A relatively 1:1 risk to reward kind of trade setup. Is as simple as this. So this is the kind of setup GJ gave. I'm just introducing you to some exclusive content right now. So Take your time. If you don't understand it the first time, watch it the second time, watch it the third time. This is invaluable. In fact, it is priceless. I'm not going to hype it too much so that you don't forget the message and listen to the messenger. So, with that being said, look at how beautiful price has traveled today. Very beautiful. As you can see, we are in a clear bullish market. Okay, no indicators here. Clear price action, reading of price. And this is one thing I have noticed. One thing I have noticed. Okay, when the daily time frame is in a bias territory and the 4 hours in a bias territory, and you have managed to enter a trade either on the 4 hours or the 1 hour, you are expected to get a very strong impulsive move in order to meet the demand coming from higher time frame. I don't know if that makes sense, but if you didn't catch it at the first time, if you didn't catch it, watch it again. In other words, the request made by a child can be dampened by the parents if the funds is not available. Okay, but the request made by the parent cannot be dampened by a child because the child has to obey the parent's demand. So if a child says, Daddy, I want 2 cubes of sugar, and the father says no, but the father says, Son, I want you to take or do your assignment, the child cannot say no. He has to obey the request of the father. Because if he doesn't, there are consequences. In other words, if the demand for buys is coming from a higher time frame than the time frame we are trading on, we are anticipating what? More impulsive push. So this is just what I want to give out for British pound, Japanese yen. Okay. With this being said, I'm expecting gold to be bearish. Why am I expecting gold to be bearish? Because at the moment there is a what? There is an inverse relationship between pound yen and gold. Yen is weak against the pound, but the dollar is stronger against the gold or against XAU, which is the basic or primary factor we are looking in this relationship of gold per US dollar. This is what I mean. If you put pound yen, okay, you put Great British pound, if you put Japanese yen, I beg apologies, and you put US dollar, this is what it means. US dollar will be +2, British pound will be +1, yen will be what? 0. This is just a mathematical value, not that yen is 0. Okay, that means gold is stronger than US dollar is stronger than pound. However, pound is stronger than yen, but gold itself will be stronger than yen but weaker than dollar. That is the relationship I'm trying to paint. This is going deep. This is a little advanced. Please, if you don't understand it, I understand. Ask me a question, but I don't want to go too deep. I like keeping the messages in a way that everyone can absorb what is being, the liquid that is being sent out. It's just like be a sponge to absorb. It's better to communicate effectively than to impress. That is my own understanding of public speaking and communication. Okay, so I'm giving a message. I want you to at least get anything from 75% is good for me. Anything greater than 75% to you is good for me. That means you have absorbed a good percentage of the message I'm trying to dish. So this is for British pound, Japanese yen. Looking at gold, let's see if that maintains. You see, now you see for British pound, Japanese yen, we are going up. For gold, we are doing what? Coming down. So anywhere you pick sales around here, you're expected to do what? Get good profit. But don't forget one trick people always forget. Buying at the top gives you a reasonable amount to play with when price runs down, but trying to selling at the top rather gives you a reasonable amount for when price is going down to do what? Keep adding positions and holding. Now we are approaching a level where you have to ask yourself, are we close to a reasonable point where price could bounce off? We can't tell that just looking at it from the time frame we are trading. So we have to go a time frame higher. Now, daily time frame, what is it going to show us? As you can see closely, price virtually took out this support. Price is approaching this level. Now there's a consolidation here, but I can't really tell if that consolidation is a demand consolidation. Now we only can tell at this point. So as you can see here, this is a place where price could react from. And how do you know where price will react from? I'll give you one tip now. Watch very well. When price was going up, it started giving us longer top wicks. This will tell you that something is about to happen. The bottom wicks will show that okay, price is rejecting the drop, but the top wick will have to indicate where price is playing out, and the body will tell you the volume. Now I'm taking the concept from Raja Banks. People underrate Raja Banks, but that guy drops rare gems all the time. People just try to abuse the message because they hate the messenger, but the message does not invalidate itself. It is verifiable and is a fact, which is you can use body of candles to know volume. The bigger the body of the candle, the more interest buyers or sellers have. Like this place, you can say more sellers are interested in this because this is where price opened, market opened, this is where it closed for that week. So sellers were interested in selling. You see here, these top wicks indicating that buyers tried to go up, but they were pushed down. Buyers tried again, pushed down, and the candles closed weak. That means the buyers were there, but weak buyers. So we have to see if we're going to get a bearish breach of this and again of this. If this occurs, then we're anticipating what? Further bearish momentum. So this is for gold. Again, like I said, I'm not going to ask us to start drawing Fibonacci using of EMA. I don't have anything against using of indicators. Get me? Okay. But the point here is we can use structure, price action, infusing with our fundamentals to have a beautiful understanding of the market direction. Now, price has dropped reasonably to a demand level. Now, if this demand level is in, as in violated, whereby we get a bearish breach, we'll be anticipating what some retracement phase before continuation to the downside. However, if price respects the demand level by printing bullish candle, either this week after tapping here or next week, we'll be anticipating price to do what? Continue upwards. But then again, this is one gem I want to drop. Then again, some people will say, oh, when gold starts performing strong, I told you gold will come back. You see, the fundamentals has pointed that dollars is weak due to what Fauci said, due to what the president of the United States or what's happening here or there. That's what's making dollars strong. But this is the gem I want to drop. Your fundamentals only does what validates your technicals. Fundamental validates what? Technicals. I'll say this one more time. Fundamental validates technical. So once price taps this demand zone, there's possibility that it will go up. Now next week you're going to hear, okay, next week we might have the not farm payroll NFP. That will now be that price could push upwards. If price push upwards, people will now say, oh, non-farm payroll, very good. That's what happened. It has made price push. No, people spending orders were waiting here. There is an imbalance that occurred here, whereby that imbalance was what made price to go up. And some people's orders that were not filled or were created after price rally is still waiting here, which will now cause some hula baloo, rigmaroling of price here. If the buyers, the volume of the buyers become greater than the volume of those who are interested in selling, what do you get? An upward market direction. So this is what could happen next week. If price taps here like it has done and pushes upward, we are anticipating it to rally to retest this high or continue pumping. However, if the NFP happens and price breaches this low, then we gauge the momentum of the retracement to be weaker than the leg coming down. We anticipate what? Further bearish momentum. Now, this is again another advanced concept that is very easy. Very easy. Watch all the videos that preceded this, the ones that came before this. If you don't still understand it, take your time. Forex is running nowhere. Stocks running nowhere. Bonds ETFs, running nowhere. Whatever, even if it's options trading you want to do, it's running nowhere. Take your time. I studied professional, of course. Yeah, I'm an engineer by profession, by training. Masters in reservoir engineering by training. If I could spend more than 5 years to do my BNG and MNG, why can't I spend years trying to get something that could pay me more than what I could do as a reservoir engineer? With that being said, why is thou taking less time or rushing the process? This is what happens. This is what happens. The more you spend time observing your chart, the higher your progress. But this is the beauty of it. This period here appears like no change is occurring. In fact, I was nice on this. This is how the curve occurs sometimes. This period appears as if nothing is happening. This could be 1, 2, 3 years. Somebody could spend 3 years. I feel like, God, I spent 3 years of my life. I'm not learning anything. Now, this is what someone has learned. Okay, what someone has learned. This is time. Okay, what someone has learned versus time. It will look as if the person is not, time is going and the learning is appearing like there's nothing showing here. But I bet you all it takes is just one simple concept to understand, and you get that you have been taking your time just like a palm seed. You have just been growing, establishing yourself so that the root that will be formed will be so strong to withstand whatever might come against you. Now, this is something I've learned over the years of trading. Greed is very, very, very detrimental. It's bad. Let me explain. If you take a greedy trade, this thing, instead of using 1% or 0.5% or 0.25%, you want to use 2% or 3% or 5%. Today you make 5%. Next day you make another 5%. And now you want to pump it to 10% because you've seen that when you use 5%, you got twice. When you're going to lose, if you use 10%, you're going to lose all the ones you earn, even using your 5% or 3%. Why? Because this is how the market algorithm works. It's not kind of shift or something. Once price is pumping in your favor, it's as if the money is not increasing fast. Once price is going against you, it's as if it's depreciating fast. Have you noticed that? What does that mean? It's very simple. You enter here, you put your stop loss here. Let's say you put your TP here, or let's say even if your stop loss is here. If price drops against you, it drops fast, and if you're using 10% of the account in order to make 50%, it looks as if, God, what is happening? Every small move down is as if you're losing large. But this is one thing I've noticed. Using a consistent value and increasing consistently reduces that illusion that more money is being lost when you increase in a very fast way. I'll repeat it just quickly. If you increase your risk appetite 1% until you make, let's say, 10% or 5% of the account, and you increase from 1% to 2%, then you get 15 or 20% of your account, you increase it to 3%, you make 40% of your account, and you remain, let's say, from 1%, you at 1% risk allowance, you get to 10%, you increase to 2%, you and the trades is working your favor, you get up to 20%. From 10% to 20%, whether you make money or loss, you don't change this 2% of your risk. So if you lose, it's minus 2%. If you win, it's plus 2% back to 0% plus the negative commission, which is what you have to pay. Now, if you reach 20% and you say, okay, I want to remain on 2%, you retain 2%. Whether you reach 50%, you win or you lose, you retain 50%. Not someone loses at 2%, you now want to go back to start trading at 0.125 in order to reserve capital. What it means is that 2%, to make it out of this, you have to win over 8 times of the trade. Over 8 times of the trade, because 1% divided by 2 is 0.5, divided by 2 again is 0.25, divided by 2 again is 0.125, which is 2, 4, and 8. So you have to make 16% in order to get what? 2%, which is crazy. Okay, but that is just by the way. I don't want to go into deep math. This is what I have for gold. The last but not the least on my watch list is Bitcoin. Bitcoin is really showing some impressive bullish move. Okay, now look at this self. Its price has tapped into the demand zone. Let's see how today's candle closes. If it closes bullish, this week's candle closes. Oh, this is a weekly candle. Yeah. If it closes bullish, then we are expecting what? Further bullish momentum. But if it closes bullish and then dumps, that means we will continue our bearish momentum. Okay. Now let's look at what price is doing on Bitcoin. The last but not the least, Bitcoin is at an impressive point now. As you can see, this is weak bearish candles against the impulsive bullish candle. So what I'm looking at is more impulsive leg, as a bullish leg on the break of this high, or bearish leg on the break of this low. As simple as that. Okay, now let me zoom in so that you have a better picture of what I'm trying to show you. Okay, this is what I'm trying to show you. A break of this high will indicate further bullish momentum. A break of this low will indicate further bearish momentum. This is weak bearish candles versus the strong bullish candle, impulsive leg. So I'm expecting what? More impulsive leg. However, don't forget price is at this resistance level. So let's see if we can get a break above here. If we do this, then we'll come back to our what? Where price was hanging before we had that jump, which will now make people say, I told you Bitcoin never fails. Well, if you were holding a drawdown to this point, I'm sure you must have closed some positions or found a way to take some of the risk out of your hand. But the point is, understand structure and fundamentals will only be the fertilizer, the manure that helps you get to where you want to get to. So I'm going to stop here for now. Don't forget, this is Phoenix Unique. Okay, subscribe if you haven't. Okay, do well to subscribe, hit that notification button, and like, comment. Okay, thank you, and